I'm pleased to introduce today's distinguished speakers, Mr. Anders Hjorth Agerskov and Mr. Joseph Oliver Eloi. In addition to the speaker we previously announced, Mr. Agerskov, we have one more joining us today, Mr. Eloi. I'd like to take a moment to introduce both of them. First, Mr. Anders Hjorth Agerskov is a senior public sector specialist in the Fiscal Policy and Sustainable Growth Unit in the World Bank's Economic Policy Development Department. He is leading the unit's work on tax and digital transformation and fiscal resilience program for small island states. He is a co-organizer with the United States IRS of the Cyber Network Conference that brings together experts in crypto regulation and enforcement. His prior role, he headed the World Bank's Preventive Services Unit, which was established in response to the recommendations of the Independent Review Panel led by Paul Volcker. In this capacity, he led the Integrity Vice Presidency's risk assessment of the World Bank's global operations, due diligence on private sector operators, and support to governments on strengthening the integrity of procurement and contract management-related regulations and practices. Anders served as co-chair of the Global Blockchain Business Council GSMI 2.0 initiative on governance on blockchain-related taxation systems, co-founder of the Prosperity Collaborative with MIT, EY, New America, and Boston Global Forum, and member of the WEF Working Group on Voluntary Disclosure. And next, Mr. Joseph Oliver Eloi is an economic policy specialist in the Fiscal Policy and Sustainable Growth Unit at the World Bank, where he focuses on tax policy, digital development, and supporting domestic revenue mobilizations in emerging and developing economies. Prior to joining the World Bank, he worked at EY as a manager in the tax policy and trade policy teams, advising governments and international organizations. He recently completed an MPhil in public policy at the University of Cambridge. He with research on domestic revenue mobilizations, digitalization, and the impact of fiscal policy on economic crisis. Everyone, please warmly welcome Mr. Agerskov and Mr. Eloi.
Thank you very much for the kind words, John G. What we would like to do today is to talk to you about the taxation of cryptocurrencies. And the first thing you might think about when you hear the word cryptocurrency is the dramatic growth out of nowhere of these currencies. You may think about the busts that have happened in connection with, for example, the FTX scandal, or you may think that you should have bought some Bitcoin early on where they were very cheap. What we will talk today about is something a bit more basic. We will talk about how these different cryptocurrencies are taxed. So what we have done between Joe and I is taken a look at a country, look at the legal framework, and see these are the laws that govern how you pay taxes. How does that play out when you have cryptocurrencies? And it may sound straightforward, but it turns out to be not always straightforward. So what we would like to do is to take you through some of our insights, and we would like to make it very practical for you. Some of it is a bit kind of technical, but I think you will be able to see the same insights that we have made when it comes to taxation. So next slide, Joe. The three goals of this presentation is really for you to understand the basics of cryptocurrencies. We're not going to go into them in great depth, but at least you have the basics. We're going to talk about what are the areas of the tax law where we have analyzed where the treatment of cryptocurrency is not really clear. So if you were going to the tax authority with some questions, the answer might not be clear. And then we will talk about where in the legislation are these kind of unclarities occurring. So that is what we're going to do. We have divided up the slide deck between Joe and myself. So what I would suggest you do, please, whenever you think of something, please put in a comment in the comment section, right? And we will go through this presentation. relatively quickly, and then we'll get to some of these questions. And again, there are no dumb questions. Just please put in some questions, and then we will deal with them as we move along or towards the end. So without any further ado, let me hand it over to Joe.
Thanks, Anders. So yeah, I'll move through some slides where we'll provide an overview of what do we mean by cryptocurrency, and why is this important for taxation. So this first slide covers why should governments consider clarifying the tax treatment of crypto assets. So why are we here talking about this today? Why do we think this is important? And the first one is a fairly one of the more simplistic reasons, which is just to inform tax officials of how this should be treated. Every time there's a new technological development, it has to be threaded into the tax system in some way. Or even if there are no changes that are necessarily made to the tax system, it's important to clarify the treatment of any new type of technology. So this first one is it's important for governments to inform tax officials what they should do, even if what informing them is there's nothing that needs to be done. So second is around providing taxpayers with tax certainty. So this first one focuses on government. It focuses on tax officials and making sure that your tax officials know what they need to do. But this second one is providing tax certainty. If governments stay silent on the tax treatment of new technologies, then investors won't be able to understand their tax liability and therefore their potential take-home pay from an investment. So providing tax certainty is really critical to a well-functioning economy. It enables investors to understand what their return will be, and that is something that's very relevant for crypto assets, given the nature of them being quite complicated and the technology being very new. So this third one is more unique to crypto assets, and that's around understanding the tax evasion and non-compliance risk related to these assets. And on the next slide, what I'm going to do is I'm going to move through some of the key features of these assets, and you'll see why some of these features would potentially increase the risk of tax evasion and non-compliance. So this fourth one is to build interoperability with virtual asset service providers. So there's an obligation on governments to collect various information for its own internal purposes, but also to share information with other governments. And now virtual asset service providers, so these are your kind of online platforms through which you can buy and sell cryptocurrencies, will fall within this net. And the last one is to inform policy dialogue. Often when people think of crypto assets, the first thing they think of isn't tax. And that's because there are some really important financial, money laundering related considerations when it comes to these assets. But it's still really important for tax to be part of this dialogue because of that tax evasion risk, because of that non-compliance risk. So it's important that tax is involved in that conversation and in informing the policy dialogue. So what do we mean by defining crypto assets? So what are crypto assets? Sorry, and what I'll do is I'll read this out just so we can hear a clear definition. And what we're focusing our attention on today is cryptocurrency. And so cryptocurrency isn't often considered regular money in terms of your, for example, US dollars. It's not considered regular money. It has several features that make it distinct from regular money. And the fact that cryptocurrencies are digital and often minted and managed entirely in the private sector makes them distinct from government-backed fiat currencies. They're not backed by the credit of sovereigns. So we'll break that down into 6 key features which make them different to regular money and form part of this definition. So the first one is that they're pseudonymous, so it's difficult to identify people involved in transactions and their locations. It's also transparent. So while it's difficult to identify the actors involved in these transactions, the transactions themselves are clear. So, you might be able to see the train tracks, but you're not able to see the actual station. So you're able to see the underlying transactions that are taking place, but you're not able to identify who is taking part in those transactions. So it's decentralized. So in terms of validating transactions or validating various assets, this is done in a decentralized way through two primary mechanisms known as proof of work and proof of stake. But for the purposes of this slide, we just need to understand that instead of it being a central authority like a bank or a government that will validate a certain transaction, when it comes to cryptocurrency, it's validated by the network. The network will work out a complicated code in order to validate that a certain transaction is legitimate. It's accessible, and by accessible, we mean it uses the internet. So it doesn't matter whether you're in London, Washington, Seoul, Kathmandu, Pretoria, it doesn't matter where you are, you're able to access this network. So it's secure, it's based on cryptography. So it's without the power of quantum computing, it's an unbreakable chain. So it has that security there in terms of that transaction chain is unbreakable. If there's a transaction from A to B to C, you're not able to go back and change that or mask that. It's transparent, but it's also secure. And it's immutable as well. So the inability of on-chain records to change or be changed. So what are some of the trends? As Anders said, there's an increased importance around some of these assets. What I'm sure a lot of us have heard of is actually the volatility related to these sorts of assets. So in terms of the value of them, we've seen sharp increases and we've also seen sharp falls. So central bank digital currencies, we're seeing a number of countries start to introduce their own type of cryptocurrency, which actually is something that's controlled by central government. So there's a lack of general action around these sorts of assets, and I mean they're complicated. They're used in complicated ways, and because of the features that we touched on the last slide, there's been a lack of just general action, a lack of guidance, a lack of policy related to these sorts of assets. And adding to that, there's been a lack of tax action, with most jurisdictions having yet to formalize a tax strategy related to these sorts of assets. And what do we mean? So we've talked about cryptocurrency, and when we talk about cryptocurrency, we often mean these two buckets here in the middle, non-stable coins and stable coins. So on the far left, you have what we refer to as investment or your utility crypto assets. So these are things like NFTs. So that can be something that say represents a piece of art, but you're able through cryptography to identify that as a single unit, as a single asset. So by investment or utility, it's because they're often purchased to increase in value or they're often used for a specific purpose. Now we have non-stable coins. Now this is something where it's what you would refer to as your standard kind of cryptocurrency. So things like Bitcoin and Ethereum are the two biggest ones, the two most popular ones, which you might have heard of. And there's no intrinsic link to an underlying asset there. It can vary in price. It can go up and down. Whereas stable coins, the third bucket here, they are actually typically pegged to an underlying currency. So for example, Tether or USDC. And the last one is settlement tokens. So these are your central bank issued currencies. And this is the last slide just before we move to some questions. And this walks through the crypto asset life cycle. So we start here with creation. And the most common way of creating a crypto asset or a cryptocurrency is through mining. So you can see in that third row down there, mining. And what happens is we talked about this being decentralized. We talked about these transactions being validated through the network. Those doing that validation need a reward. They need some sort of incentive in order to validate certain transactions. So let's say I've sold my cryptocurrency to Anders. What the rest of you all do, let's say everyone on this call is part of the crypto network. Everyone else on the call will effectively be racing. We'll racing to solve a code. So it'll be like a formula. So I will sell something to Anders, and underlying that will be a formula, which if we can crack that through various complex computing, we're able to actually validate that transaction. So everybody will use their computing power in order to validate that that transaction is valid. We confirm that I am the owner of that asset and I have sold it to Anders, who is now the new owner of that asset. Whoever cracks that underlying code first gets a reward in the form of a new token. So that's what we mean by mining. So you're putting in work, which is the proof of work system. You're putting in work to verify a transaction, and if you get that answer right, if you crack that code, you receive a token. And then when we talk about Bitcoin, there is a limited number of Bitcoin that you can receive for validating transactions. And then there's forging here, which is slightly different. So because of the computing power around validating transactions, or everybody racing to validate a transaction, what forging does is it's almost like an election. It's like a vote where everybody in the network will put forward what they think the answer is. And then whatever is the most common answer, everybody who got that answer correct will receive a much smaller reward, or out of those people that have got it correct, there might be a random allocation. So that's what we mean by forging and mining. And then airdrops is like if you were to create a new coin, an airdrop is it's almost like an advertisement, like a sample. You know, like similar to a sample, if you're walking down the street and there's a cookie salesman who might have broken up a cookie and is handing it out for free. That's what we mean by airdrops. It's giving various actors a set of tokens, all in order to try and promote the use of that token. I'll move through the others fairly quickly. So storage and management. What we mean by that is once you've created your token, how do you hold onto it and how do you manage it? So there's various services around that. So you've got your wallet where you would keep that. There are people that provide services in order to hold on to that. There are various financial transactions which can happen, known as DeFi, decentralized finance, where you can loan and borrow. And then so that's storage and management, and we're going to move to transacting. So this is the buying and selling of cryptocurrency. So you have certain exchange platforms where you can do this through, or you have direct exchanges. There are people that are providing services to facilitate those transactions. And we've talked about this already in the context of mining and forging, which is verifying those transactions. And then lastly, we've got destruction or disposal. How do we get rid of these tokens? And so burning is removing it from circulation. We've got at the bottom there theft. And what do we mean by theft? That could be you have your crypto assets in an online wallet, and you simply someone will get access to your password. Whereas loss is similar, where you just simply lost your password, so you're not able to access your wallet anymore. And then this last one is a fork. So what happens is we've already talked about this being decentralized. So, and we've talked about getting a reward for validating transactions. Now that is based on a set of rules which can be designed by the network. And a fork can happen when people that are part of that network that are voting on the direction of travel of how this cryptocurrency or crypto asset works have a disagreement. And they have such a big disagreement that they actually decide to split the network. So everybody had one token, but now suddenly they've got two tokens. One which is operating under the old rules and one which is operating under the new rules. So this is what we mean by the crypto asset life cycle. So as you can see throughout all of this, there are some tax questions related to a number of these things in terms of new concepts that we've never heard of before and how do you treat that, or we see crypto assets being used, say, in traditional transactions. So I'm going to pass on to Anders, who's going to go through the first set of question slides.
Thanks, Joe. So take the first situation. You got a job and you get paid in Bitcoin. So the first question you may ask, should I pay personal income tax? And you would think that maybe you should, because then everybody would be paid in Bitcoin, right, and avoid paying income tax. Then you may be thinking, okay, why is Anders raising this question? Well, because if you're paid in Bitcoin, and some countries consider Bitcoin not currency, right? but it's like an asset. It's like if you're paid, let's say a barter trade, you're paid you get a cow, right? Or you do some job for your neighbor, the neighbor gives you a case of wine. Is that really income? So if you look at barter trade, in most countries it's considered income. And this, if you consider it more like an asset rather than currency, then you would say it should be subject to a personal income tax, right? Otherwise there would be a lot of problems, but it's kind of a fundamental issue. The second question you would run into, so when is it recognized as income, right? So generally speaking, countries will recognize it as income when you get the money in your wallet, for example. Will not be the end of the month and so on. And you'll then say, okay, so how do we determine the value? Well, if you get the money today, you would look at a Bitcoin exchange, what is the value, right? And that would be pretty easy. There are some cryptocurrencies where the value, especially decentralized crypto exchanges, where it's not obvious. That's why some countries have used the term fair market value, right? So the basic tenet here is almost all, if not all countries, want you to pay the taxes in the local currency, not in crypto, not in all sorts of other things. So everything gets converted into that currency. So that would be wrong if it's in South Korea, right? So what about withholding taxes? So withholding taxes are your employer holds back part of your salary and gives you only part of it. And the employer will typically remit, send that to the tax authority, right? So is your salary subject to this? Yes. The question then is, how does the employer send the money to the tax authority? Because most will not accept Bitcoin, for example, right? So that would then need to get transformed. Also, there are some complexities. If you're the tax authority and you set up a form that the employer has to fill out, if there's no field for Bitcoin and the daily value, it's getting a little bit complicated. So you're beginning to see how these cryptocurrencies are causing all sorts of problems. Then you may say, well, gee, I got my salary today and the market crashed tomorrow. What then? Well, generally speaking, for personal income tax, it's too bad. But how these losses are dealt with is then like an investment, and there are different ways to calculate that, right? So it would be typically considered that kind of a loss. What about airdrop? So Joe talked about you getting a piece of a cookie on the street. So the way it works is, it is not like you go and ask for it. They secretly put it in Joe's pocket, right? So he gets it like that without knowing it. So the question is, should Joe pay taxes off that part of the cookie? And when should he do it? When he discovers it and so on. So it gets a little bit complicated how we deal with that, right? So that's why we bring it up as an issue. Do you want to talk about stolen Bitcoins, Joe?
Yeah, sure, happy to. And just to add on that question around airdrops, there's no right answer to this because it's new. We see some countries which treat it completely differently. I think the United States is an example where they have a particular law. I can't remember the name of it, but it's something to do with like discovering income or almost kind of income happening to you without you knowing. There's a phrase which I can't remember off the top of my head, but so in that scenario, you can see how accession to wealth is the phrase I'm looking for. It's accession to wealth, and I think Australia have something similar. But lots of other countries don't. So most countries would say, "Oh, you have no idea that you were going to receive that." But Australia and the United States, well, actually, it's potentially a very different answer to that question, which is why this is such an interesting topic, because these are fundamentally different types of activities to any that we've seen before. And yeah, so question three here, your Bitcoin gets stolen, and so the first question is you know did you really ever have it in the first place? All you ever had was as a password, and so and it's similar to that question around when you lose it, when you lose a Bitcoin, have you actually lost it? It's still there, it's still under your name. So if your Bitcoin gets stolen, is that tax deductible? Because also, if it's anonymous, if we don't actually know who owns what, you can come to the tax authority and claim that you've lost your Bitcoin. So some tax authorities have said, no, you can't deduct stolen Bitcoin. Not because you're not entitled to it. In lots of scenarios, if your things had been stolen, that would be tax deductible. If you, again, going back to our cookie example, if you sold cookies and all of your dough got stolen, all your sugar got stolen, you'd be able to go back to the tax authority and say, I paid for VAT on this sugar, and I want that back. I wasn't able to deduct it. I wasn't able to use it in my sales. Or if you make a loss as a result of your costs, you'd be able to deduct that. In the case of Bitcoin, some tax authorities have turned around and said, I'm sorry, it's just too complicated. The risk is just too high. For this particular scenario, we're actually going to say that your loss isn't deductible.
So this is another example. Yesterday you bought a Bitcoin for $113,000. Yes, that's how much it's worth. And 3 years later, it drops to 52,000. So it's not quite a theft, but it's a loss to get to deduct it. So, for example, my country, Denmark, no. What if it increased? Would you then have to pay taxes of it again, my country, Denmark? Yes, you would. And then you say, that's not fair. So I cannot deduct losses, but I have to pay taxes of income. So then again, in my country, what happened is a person who was trading a lot in crypto, all of the losses cannot be offset against the gains. So that could be extremely expensive, right? So that's why having clarity on these type of issues is very important, right? Some tax rules also say you can only deduct the losses for the same kind of transaction. So you cannot deduct the loss against other kind of income things you're selling, only up to the maximum of what you earned on, say, the crypto. So the next question is, why might the loss deduction depend on whether you are self-employed individual, a company, or currency trader? So the reason why that is so, think about it. You bought some US dollars and they increased or they dropped in value. Would you really pay taxes from that? No, you wouldn't, right? What if it's a company, a regular company doing import-export? Well, it would be allowed to do that, maybe at the end of the year, something like that. But if you're a currency trader, often governments allow what's called mark-to-market. That means you can, on a daily basis, say, well, now my Bitcoin went up or went down or whatever, and use that to adjust the value of your cryptocurrency, right? So then the question is, let's say you buy, let's stick with the Bitcoin example, Bitcoins over time at different prices, right? So you bought it at one time for $113,000, another time for $123,000. Let's say you're going to sell it. Is that the $113,000 Bitcoin you're selling, or the $123,000 Bitcoin? What happens here is, and that is not unknown, that same thing happens with if you're currency trading. So you have, is it first in, first out, or last in, first out, or how do you deal with that? So you as a company, as a trader, you have to say how you want to deal with this. And you cannot just shift back and forth how you want to do it, right? Because if you bought it very cheap, some cheap and some very expensive, maybe you want to sell the expensive one in order not to have a capital gains tax, right? So that's why companies are required to kind of stick with one way or the other. Another question is, let's say you bought some Bitcoin, some cryptocurrency on foreign exchange, or sold it there. Would you have to pay taxes in that jurisdiction? Let's say the crypto exchange, for sake of argument, was in the US and you made a huge profit. Would you have to pay to the US IRS? So it's not just a hypothetical, it's something they're discussing in the US. And they have, if it were stocks, you're buying and selling stocks on the New York Stock Exchange, even if you're a Korean, you would not pay taxes. It's called their safe harbor policy. And the discussion is going on whether that should be applied to cryptocurrency as well. Then we have a kind of a tricky one in question 5. So you have cryptocurrency which has depreciated significantly, but you still want to hold on to it. So the issue here is if I have a cryptocurrency where I've had a huge loss, it is my interest to realize this tax loss as quickly as possible, because then I get a tax deduction. But if I don't want to sell my currency, what do I do? Well, some go and just settle by it immediately, right? And then you realize the loss. But for example, in the United States, they have a prohibition against that because it's really a constructed sale, right? You're not really selling it, right? Similarly, you could also, if you want to sell your cryptocurrency, but you don't want to pay capital gains tax because it's gone up a lot. That's the opposite. So you made a lot of money, you really want to sell it, but you don't want to pay taxes on that income. So what you can do is you can short sell it. You can go in and put a price that you're willing to buy it for, you're willing to sell it for, in two separate instruments, and effectively you would sell it, your currency, except you wouldn't really sell it. And these are ways that companies and individuals try to get around these kind of capital gains rules. And that's where you have the anti-avoidance rules. They're not saying it's illegal what you're doing, but they said, no. You just pretend to be selling it, or you're actually selling it, but you pretend not to, and we're not going to accept that, right? So this is the anti-avoidance, if you are expert in this area, that governments like in the United States and United Kingdom are trying to apply to cryptocurrency.
Just one comment to add on this slide, and it's around question 4, and Anna's outlined the complexity here really clearly, and the numbers that we've got on screen might seem unrealistic. A change in value from $50,000 into $113,000 in 3 years. But in the case of Bitcoin, it's so volatile that that's really quite a realistic change. The largest jump in the value of Bitcoin was in November 2024, where the value of Bitcoin in just one day, it jumped by nearly $10,000 in one day. So if that can happen in one day, then this can happen in 3 years. So it really, really adds to not just the complexity of this scenario, but also why this is so critical for tax authorities to get this right.
Yeah. And while you get the next slide on, there's also another question here. If I sell my cryptocurrency to somebody independent, how do you know who the other party is? Maybe I'm just selling it to myself and making up some fictitious price, right? So the whole arm's length thing can be a bit difficult to determine, right? So question 6, you buy goods and pay in cryptocurrency, are you liable for paying VAT? Generally, yes. It's a pretty straightforward thing. What if these were not goods but services, more specifically the cost of the monthly crypto wallet fee? Well, Joe is more of an expert here, but let me just answer this partially and then hand it over to Joe. What you often see in countries is that financial services is not subject to VAT, right? So the question is that monthly crypto fee considered a financial service in that country, right? But there could be other questions. Maybe Joe, you want to chime in here?
Yeah, so I mean, this question 7, you mine cryptocurrency and sell it for profit. You're right. It's most countries will treat this, if not as currency, but as like a financial asset, which is typically exempt from VAT. But the exemption rules are really complicated, and like some assets are exempt, some assets aren't exempt. For the most part, it will be exempt, but still, a tax authority would need to issue guidance around that. But what exemption means is you don't charge any VAT on your supply, and you're blocked from recovering any VAT on your inputs. So if you're incurring these fees, you're incurring VAT on a lot of your costs, but then you're not able to deduct those costs. It creates tax avoidance risk, it creates complexity, and it's definitely a gap where governments should be issuing guidance. And then the second part of question 7, what if the crypto asset is an NFT? So actually, it's not It's a digital form of art. It's nothing to do with a financial asset. So in that scenario, it's got VAT on it. So you've got one type of crypto asset which is exempt, another which is a piece of art or is, a utility token. But then there are lots of crypto assets that are actually both at the same time. So how do you define that? How do you draw that line in legislation? How can you do this in a way that doesn't become onerous for a taxpayer and stifle innovation in this space and force them to fork out thousands and thousands on tax advisors? It becomes really complex really, really quickly. Anders, I don't know if you want to jump in on a question 8.
No, why don't we take this is more of your area, but we're talking about the mining and so on. So the issue here is if you are part of that validation process, like Joe is selling me something, right? And you're chiming in, and you have computers running in the background. You may have seen people buying these NVIDIA cards and doing all sorts of things, right? So is that a service you're providing? Is that VAT-able, so to speak, right? Or not? Is there a supply? And as Joe would say, right? Or not? How do we think about this, Joe?
Yeah, because it's a really, really interesting question, because let's think about traditional finance. Let's think about something like for financial advice. Now we say, okay, that feels like finance. That sounds like finance. It walks like finance, and that's typically exempt. Okay, what about financial consulting? We're talking about like a consultancy firm like McKinsey, which is giving a bank advice about finance. Okay, it's kind of moving further away. So maybe that's not finance. Maybe that's like advisory. Okay, now I'm going to give somebody legal advice about a financial transaction. Again, that's probably more close to VAT. So you can see the complexity already with the financial exemption. Now we've thrown cryptocurrency in the mix. What is mining financial? Because in theory, you're validating a transaction, but at the same time, it's kind of a reward. Is that a gift? So is that just completely out scope the VAT, because gifts are outside the scope? Or is this like consulting services? Are you giving your opinion? And you can see why it becomes really complex really quickly. I mean, it's complex. The starting point is complex. The financial services exemption is complex, and we're adding an extra layer to that.
Yeah. And again, if you're not a tax expert, often countries accept the financial sector services from VAT, right? So what we are trying to do here is to say, this is what the rule says. If you look at the law, look at the tax code in, say, Korea, and see what does it say about financial services. And then you think about what Joe and I have been talking about the trading in the Bitcoin. So exactly how does it match these words? So that is what needs to happen, right? And if that is not clear, people would need to look at if there has been some case law on this, or maybe there's a tax ruling or something else, which of course can be challenged at court, right? So we're trying to stick very closely to the legal language.
We've just got a couple of slides here with a little bit more information. I've just got a little sound that my headphones are about to run out of battery, so you might lose me for 5 to 10 seconds as I switch over. So what's the international kind of approach to this? So what are countries doing in order to tackle this? So the first one is most countries are trying to align these assets as much as they can with their existing tax legislation. They don't want to create new laws. They don't want to, change their existing in tax infrastructure. So they're trying to align this as much as possible. And now that's often a good thing in terms of tax certainty. It gives people clarity of how the law operates. But that does mean when it comes to kind of a technological, innovation, it means that you might not have the most neutral or the most equitable tax law. So the second is most countries are treating this as financial property. Again, where you draw that line for an exemption is blurry, even for finance anyway, but most people are treating it as some sort of financial property. Most countries are taxing it at creation. So whether that's mining or forging, in some way, countries are trying to tax this. There isn't complete consensus of where this first tax point happens, but most countries are trying to get there at the start. And in terms of the administrative side of things, information reporting is king. So information reporting from from miners, from virtual asset provider, service providers, all from tax administrations sharing information amongst each other. Information reporting really is king. And the World Bank has an emerging and developing economy focus. So what is different in an emerging and developing economy scenario? Is there anything that's different when we talk about this? And for the most part, no. For the most part, most of the issues are pretty similar. All of the core key issues related to these sorts of assets in a developed and a developing context are pretty consistent. There's a few ways that assets are used differently, which means that we might ask some different questions. So one, crypto assets are used actually a lot more in lower value, higher volume transactions. So there are more users in the developing world, but the actual value of those transactions are less. And it's because they're typically used to send remittances to avoid charges when converting money or sending it overseas. As to protect against financial and economic instability. So often when we see currency crises, we see large upticks in the usage of crypto assets in certain countries, and to facilitate aid and fiscal transfers. So in the developed world, it's high value transactions, sorry, developed world, high value transactions with the intention of using that as an investment to increase the value. In the developing world, it's more about value preservation, and it's lower value, higher volume transactions looking to preserve the value of their transactions as they move it across borders or they protect it from economic and currency instability. So, there are some issues around
tax and things like that, which are different. So for the most part, the actual tax conversation is pretty similar in both contexts, even though the usage does differ. And I'll flick through these slides really quickly, which is just how we've summarized the issues. We've covered most of these in the slides. So, the tax treatment of those traditional financial transactions, whether that's wages or buying and selling, the tax treatment of specific crypto-specific transactions. So we've talked about airdrops. We've thought about things like forks and mining. How does that operate in that scenario? One thing that we haven't talked about is jurisdiction. Where do these transactions take place? Where are these types of assets held? The nature of this is very difficult to drill down who owns these assets. So it's difficult to understand where that should be taxed. Anti-avoidance, again, we've talked about this. The pseudonymous properties of these type of assets means avoidance or anti-avoidance for government is really, really important. Strategy and policy coherence, we'll talk about that we'll go through this in a question. But what we mean by this is how do you align your crypto tax strategy with your broader government strategy to crypto? And this last one, we will come back to this, but reporting, we've talked about information sharing being really important. Back to you, Anders, just for this question.
Yeah. So Joe raised a lot of interesting points, and we cannot go through them all, but this is just to talk about the policy coherence. So who's going to have a say on the regulation of cryptocurrencies? So obviously, the Financial Regulatory Authority, one, they are focused on the stability of the banking system, right? So they want to say something. And there's the tax authority because they want to tax the crypto-related income. And then, of course, you also have the accounting profession because how you account for these cryptocurrencies matters to investors and others. And finally, you would have the Financial Intelligence Unit that would look at money laundering and these types of issues. The thing is, these four institutions have different views and different interests. If you look at the Financial Regulatory Authority, they want to be very conservative about assessing the value of cryptocurrencies because they want banks to be more solid, right? The tax authority would love to recognize anything as whenever there comes an income, right? So they would be much more on the aggressive side, early recognition of income or late recognition of losses, right? Whereas the regulatory authority wants to early recognize losses and late income. And in between, you have the accounting profession that wants to have a fair market value, so investors have a good sense what is the value of this company that has cryptocurrencies. And the financial intelligence unit is generally paranoid about people using cryptocurrencies for nefarious purposes, right? So again, you see how this plays out. Who is wrong? The answer is nobody's wrong. How can we forge a consensus? Well, what we believe is you cannot have the four bodies send different signals to the private sector on how to deal with this. There needs to be some coherence. They cannot have different definitions and so on. It's not going to totally align, because also today, when the regulatory authority recognizes losses on regular loans, is in many countries not exactly the same as when the tax authority does it. Also, we know what you're allowed to write down your inventory for tax purposes may not match exactly what is the value of these assets. So today there are discrepancies, but minimizing the discrepancies will really be the way to go. So this is all we have for you in this presentation. We're open for questions at this point.